If you've got questions about financial consolidation for multi-companies, you've come to the right place. In this video, we'll cover some of the most frequently asked questions from companies worldwide. Whatever the size of your organization, it's important to understand the fundamentals of financial consolidation if you plan to scale and grow. Multi-companies are also known as multi-entities, which include a parent company with various subsidiaries and divisions. A few examples of multi-company formations include when companies acquire new entities through mergers, when a parent company acquires another company, when a company establishes independently structured international offices. Regardless of the industry, financial consolidations for multi-companies is required. Whether you're a small, medium, or large organization, multi-companies need to consolidate financials for a period end to close their accounting records. Financial consolidation is essential for several reasons, some of which include accurate forecasting and strategic mapping of company goals, aligning entities based on key performance metrics, compliance with accounting standards ASC 810 and IFRS 10, ability to get an accurate picture of overall company health, and convincing stakeholders to make strategic investments. The problem with consolidated financial statements is that they do not provide a separate view of the financial position of the parent companies and their subsidiaries. Your company must have the ability to review the financials of each subsidiary separately. Suppose you're setting up your accounting processes post-merger or acquisition. In that case, it's best practice to make sure it's possible to separate financials and quickly and efficiently consolidate them for period ends. It's possible to use software that allows for this kind of visibility while still allowing you to consolidate your financials effortlessly at period end. That way, your company can track individual entities' performance and invest strategically, rather than treating all entities the same. Companies will often see some entities perform better, so it's crucial to be able to scrutinize and drill down into each entity's financials. In consolidation accounting, the information from a parent company and its subsidiaries is treated as though it comes from a single entity. The cumulative assets, revenues, and expenses are recorded on a parent company's consolidated balance sheet and consolidated income statements. Accounting report regulations require the consolidation of parent and subsidiary companies' financial statements into one set of financial statements for the entire group of companies. This is regardless of whether the subsidiaries operate as single legal entities. The subsidiaries' financials are reported on the parent's statements in consolidated financials. A multi-company business must consolidate when one company has a majority of voting power in another company, with over 50% of the subsidiaries' outstanding common stock. However, if the parent has minority ownership, it may still need consolidation accounting if the parent exerts significant influence over the subsidiary's business decisions. Then, consolidated financials must be prepared using the same accounting methods across the parent and subsidiary entities. These include the consolidated statement of income and the consolidated balance sheet. The consolidated financial statements only report income and expense activity from outside the economic entity. All intercompany revenues and expenses are omitted to avoid double counting revenues and expenses. Any revenue earned by the parent company at the expense of a subsidiary is omitted from the consolidated financial statements. This is because the net change in the financial statements is $0. The revenue generated between related legal entities is offset by the expenses from the related other legal entity. Like intercompany transactions, intercompany account receivable balances and account payable balances are eliminated from the consolidated balance sheet. This is to ensure that intercompany balances are reported as a net of $0. All outside cash, receivables, and other assets and liabilities are reported on the consolidated statements. Consolidated financial statements help multi-companies or multi-entities comply with accounting regulations, both locally and globally. As of March 2018, over 120 countries in the EU, Asia, and South America use the International Financing Reporting Standards, or IFRS. The US still uses the Generally Accepted Accounting Principles, or GAAP. IFRS is designed to bring consistency to accounting language, practices, and statements, to help businesses and investors make educated financial analysis and decisions. IFRS sets the standards for transparency, accountability, and efficiency for financial markets internationally. In the US, the parents and subsidiaries still use GAAP for consolidated financial statements. GAAP consists of 3 important sets of rules: the basic accounting principles and guidelines, the detailed rules and standards by the Financial Accounting Standards Board and its predecessor, the Accounting Principles Board, and the generally accepted accounting principles. When it comes to compliance for the consolidation of multi-companies, the 2 most important accounting standards are ASC 810 and IFRS 10. Consolidated entity reporting depends on who controls what. Generally, all entities subject to the reporting entity's control must be consolidated, although there are limited exceptions for a reporting entity defined as an investment company. Multi-companies that track consolidated financial data on spreadsheets often wait for data from their subsidiaries, adding to the delays already inherent in manual accounting processes. With a consolidated accounting solution, organizations can consolidate financial statements, income statements, balance sheets, and close the books quickly with improved accuracy, while facilitating regulatory compliance. Another benefit is controlling user access and preventing unauthorized users from accidentally or deliberately tampering with another entity's data. Without proper monitoring, these entities can spend over their budget, make data entry errors, or be subject to theft and fraud. We know this is a lot of information to digest, so we're just going to leave it here for now. If you have any more questions about financial consolidations for multi-companies, be sure to reach out or visit our website where you can find plenty of additional resources on this topic. Thanks for watching.